Become the top 1% of investors with growth investing strategy. Growth investing secretly has been a successful strategy behind the many well-known investors in the industry. Mr. Rakesh Jhunjhunwala's famous bet on the Titan stock back in 2003 is an ideal example of using the so-called growth investing strategy. But the main question which we will be answering is, how do we identify and embrace such opportunities, just like the top 1% of investors, like Mr. Radhakishan Damani, Mr. Rakesh Jhunjhunwala, and worldwide investing gurus like Mr. Warren Buffett, Peter Lynch, Bill Ackman, etc. So make sure you hold tight and stick till the very end of this exciting video. Chapter 1. Basics of Growth Investing. According to Warren Buffett, it is far better to buy a wonderful company at a fair price than to buy a fair company at a wonderful price. So, what is the point Mr. Warren Buffett is trying to make? Let's have a closer look through an example. Let's say you bought 2 plants for your garden at home, and you plan to take care of them for the next 5 or 10 years till they grow into a tree. So over here, each plant represents a different investing strategy. So, the first plant you bought was really cheap for its price, representing buying a fair company at a wonderful price. Similarly, the only downside was that the plant was infected with a few insects. On the other hand, the second plant cost you a premium price, as it was much healthier than the first one, which represents buying a wonderful company at a fair price. Now, visualize these 2 plants in front and ask yourself, which plant has more odds of growing up into a healthy fruit-bearing tree? The second one, of course. कुछ इसी तरह growth investing का concept भी framed है. Companies with great growing prospects like market dominance, financial records, etc., regardless of the current intrinsic value of the stock, are called growth stocks. And investing in these stocks is called growth investing. Growth stocks are like a wave. Now, the most ideal time to dive into this wave is when the waves are small. And the best time to exit is when the waves have grown to a point where the chart starts to get flat. Now, before we start talking about a few growth stocks we've had in the past decade, consider giving this video a like, so we can know how our content is getting perceived as. Chapter 2. Growth Stocks of the Past. Just as mentioned earlier, the only visible difference between growth stocks and stocks belonging from other categories is that it focuses on stocks that are focused on nothing but growth. Simple as it sounds. Number 1. Pi Industries Limited. Pi Industries Limited is engaged in the manufacturing and distribution of organochemicals. At the moment, their stock trades at around 3,400 rupees. Around 5 years back, the stock was trading at around 900 rupees, which translates to almost a 300% return till date. Number 2. Deepak Nitrite Limited. Deepak Nitrite Limited is a chemical manufacturing company. The company's segments include bulk chemicals and commodities. As of December 2022, the stock trades at around 2,100, and 12 years before that, the same stock was worth around 17, a miraculous return indeed. Number 3. Vaibhav Global Limited. Vaibhav Global Limited is a holding company. It is an electronic retailer of fashion jewelry and lifestyle accessories. To date, the stock has a price of 336, and around 20 years ago, the stock was worth merely 10 rupees. Again, showing a multi-bagging return of around 3,100% returns. Next to the list is number 4, Bajaj Finserv Limited. Bajaj Finserv Limited is a holding company whose subsidiaries are engaged in the business of financial services, insurance, and wealth management. Its stock at the moment trades at close to 1,600 rupees. 15 years earlier, things were completely different. Number 5, Kaplan Point Laboratories Limited. Kaplan Point Laboratories Limited is a pharmaceutical company. The company's product segments include antibiotics, non-steroidal anti-inflammatory drugs, NSAIDs, ophthalmics, pain management, and anti-ulcers. The stock price at the date trades at close to 750. However, 8 years earlier to date, things were a lot different. The stock used to be barely worth 38 rupees. Chapter 3. How to spot stocks ideal for growth investing. Warren Buffett, one of the biggest investors in the Coca-Cola company, famously invested there in the 80s because he saw that the company had not yet expanded internationally and felt that if pushed to, the company could multiply its value. I guess this will indirectly answer your quest to find growth stocks. But if you're looking for a more straightforward answer, let's dive deep. Number 1. Always choose the leading companies. Dominating an entire market is rather unnecessary and unrealistic. A more easygoing lookout can be a specific niche dominator. As Charlie Munger said, over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. For example, waiting for a local automotive producing company like Tata Motors to go international and compete directly against big names like Toyota, Suzuki, and Honda seems unrealistic and would be too late to cash in on the growth. Similarly, to look at a specific subcategory leading stock like Tesla, for example, which only competes in the electric vehicle market, and is definitely leading at it, though when compared to Toyota or Honda, Tesla might seem like a small company, but that does not mean that Tesla does not have the potential to compete against them in the near future. Hence, in other words, companies that are relatively small and belong to a less competitive industry will have an upper hand compared to the companies that have already grown into big bullies. Number 2, keep the focus on companies' performance. A high PE ratio does not always indicate the cost of high-quality businesses, and a low PE ratio does not always indicate low cost. The factors that affect a company's long-term profitability is more important than its PE ratio. Let's say you're going out shopping to the nearest mall to give yourself a treat, and you end up at a perfume store where you end up liking 2 fragrances. However, and here's the catch, you can only buy one of them. The first perfume is very long-lasting. You like its smell a lot, but it's a bit over your budget. The second perfume falls under your budget, but its smell isn't quite convincing, plus it's not as long-lasting as the first perfume is. Similarly, in the share market, you will only choose companies that are here to dominate the market for a long run, not for short-lived 2 to 3 years. Number 3, only pick scalable businesses. A scalable business is a typical business which has the capacity to grow at itself and its competitors without having to compromise on its profitability. According to a famous American businessman of the late 1800s and writer of the book called Picking Growth Stocks, Thomas Rowe Price Jr., a business that depicts at least 5 to 10 years of continuous growth in its market capitalization and financial records, then that company or stock can be called a safe growth stock. This was all for what signs to look for in stock before stepping into the market. Now, let's have a look at what signs you should avoid, just like the top 1% of the investors do to rule the stock market. Chapter 4. The don'ts while growth investing. Number 1. Waiting to time the market. Investing in the stock market is like playing with a sophisticated adaptive system. It is hard to predict inflation, profit rates, exchange rates, the next bear market, and other economic and financial events. A more essential approach than trying to time the market is just spending time in the market. Number 2, never over-diversify unless necessary. According to Warren Buffett, diversification is a protection against ignorance. It makes very little sense to those who know what they're doing. And he's not wrong. Diversification is a risk management strategy. You give yourself exposure to different stocks, or sectors, asset classes, and geographies, to ensure that no single one of them can bankrupt you. But if you're picking your stocks right and doing as we're directing you to, you won't find the need to diversify and protect your portfolio in the first place. Number 3, don't play short term. Investing in general is a long-term play. Big players like Warren Buffett, Rakesh Jhunjhunwala, and many dozens of investors might belong to different parts of the world, but they had one thing in common in their story: buying right and holding tight. Even if you're planning to do an SIP, it would easily take you at least 5 years for your plan to mature. In other words, do not consider growth investing if you're not willing to give it at least 5 years of patience. According to Ben Graham, the man behind the all-famous book called Psychology of Money, an investor is always interested in growth stocks, especially when there's something that goes wrong with it. So, chase better prospects with whatever investing style you prefer. This was all from our site on teaching you how to invest like the legends do through growth investing. Make sure to comment down if you want us to make more content on other types of investing strategies, value investing, or dividend investing. This brings us to the end of the video. If you're already liking the content we're making, consider watching our video on the all-time famous The Psychology of Money by Morgul Housel, in which we have uncovered all the key takeaways mentioned in his book. Until next time, Omega Finance signing out.